You know what's funny about financial markets? Everyone's watching for the next crash. They're glued to their screens, waiting for stocks to implode, real estate to crater, crypto to vanish into thin air. But here's what almost nobody is talking about: the reverse crash. Not things falling apart, things shooting up so violently that it catches everyone off guard. And in 2026, gold and silver might do exactly that. I'm talking about a move so sharp, so unexpected, that the people who've been waiting on the sidelines will watch prices double or triple before they even think about buying. And by then, it'll be too late for the easy gains. Now look, I know how this sounds. Another prediction, another metal bug screaming about gold going to $50,000 an ounce while living in a bunker somewhere. That's not what this is. This is about understanding what happens when the setup is perfect, when everyone's positioned the wrong way, and when central banks are quietly doing the opposite of what the headlines suggest. Let me explain what a reverse crash actually means, because most people get this backwards. They think markets only move in one direction violently, and that's down. Crashes equal falling prices, right? But the mechanics of a crash, the pure physics of it, work both ways. A crash is what happens when too many people try to do the same thing at the same time. Usually it's selling, panic, liquidation, everyone running for the exits. But when everyone's been avoiding something, when positioning is extremely one-sided in the opposite direction, the snapback can be just as brutal. Think about it like this. If 10,000 people are crammed into one side of a boat and suddenly realize they need to be on the other side, what happens? Chaos, trampling, panic. That's a reverse crash. Prices don't climb, they explode. Here's the thing about gold and silver right now. Sentiment is absolutely terrible among Western retail investors. I mean, genuinely awful. Go look at Google Trends data for buy gold or silver investment in the United States and Europe. It's at multi-year lows. People are bored with metals. They've been conditioned by a decade of tech stocks and crypto to think that 7% annual returns are insulting. Gold did nothing but frustrate investors from 2011 to 2019. 8 years of going nowhere. Silver got cut in half and stayed there. So the average investor has moved on. They're chasing AI stocks, they're trading options, they're looking for the next thing. Precious metals? That's for doomers and old people, right? Wrong. Dead wrong. And here's why. While Western investors have been ignoring gold and silver, central banks have been buying at a pace we haven't seen in over 50 years. The World Gold Council reported that central banks bought over 1,000 tons of gold in 2022. Then they did it again in 2023 and again in 2024. We're talking about China, Russia, India, Turkey, Poland, Singapore. These aren't random countries panic buying. These are strategic accumulations by entities that think in decades, not quarters. Now, you might be thinking, okay, so what? Central banks buy gold all the time. Why does this matter now? Because they're doing it while publicly downplaying it. They're doing it while the financial media tells you inflation is beaten, that the dollar is strong, that everything's fine. They're buying hand over fist while the narrative suggests there's no reason to own metals at all. That divergence, that's the setup. Let me give you some numbers so this gets real. Let's say you're sitting on $100,000 right now. Maybe that's your savings, your inheritance, whatever. You're conservative, you want safety, so you're looking at bonds, CDs, dividend stocks, traditional safe stuff. Gold is yielding you nothing, so why bother, right? Here's what most people don't realize. The opportunity cost argument only works when alternatives are genuinely safe. Right now, we're sitting on the largest debt bubble in human history. The United States alone has $34 trillion in federal debt. That number is incomprehensible to most people. It doesn't feel real. But here's what is real. The interest payments on that debt are now larger than the defense budget, larger than Medicare. We're spending over $1 trillion a year just on interest. And it's not just the U.S. Japan's debt-to-GDP ratio is over 250%. Europe's dealing with energy crises and demographic collapse. China's got a real estate sector that's imploding in slow motion. This is a global problem. So what happens when everyone's in debt, when rates can't go much higher without breaking everything, and when the only solution left is to print more money? You get currency debasement. You get inflation that central banks claim to control but actually can't. And you get a rush into hard assets. This is where it gets interesting. Most people hear inflation and think about prices at the grocery store. Eggs cost more, gas cost more, whatever. But that's not how sophisticated money thinks about inflation. The smart money isn't worried about consumer prices. They're worried about monetary inflation, the expansion of the money supply. And they know that when that happens, paper assets lose purchasing power in real terms, even if the nominal numbers look fine. Gold and silver don't care about narratives. They care about supply and demand, monetary policy, and real interest rates. And right now, real interest rates, that's your nominal rate minus actual inflation, are barely positive. In some cases, they're still negative. That's rocket fuel for metals. But here's the psychological trap most people fall into. They wait for confirmation. They want to see gold at $3,000 an ounce before they believe it's going higher. They want silver at $40 before they take it seriously. By then, the move's already happened. The reverse crash happens in the early stage when nobody's paying attention, when sentiment is dead. Let me tell you what this looks like in practice. In 2019, gold was sitting around $1,300 an ounce. Sentiment was terrible. Nobody cared. Then the pandemic hit, money printing went into overdrive, and by August 2020, gold hit $2,100. That's a 60% move in 18 months. If you had $100,000 in gold, you just made 60 grand. If you waited for confirmation, if you bought at $1,900 on the way up, you caught the scraps. Silver did something even more extreme. It went from $14 to almost $29 in the same period. That's over 100%, double your money, but only if you were positioned before the move. Now look, I'm not saying this is guaranteed. I'm not saying gold's going to $5,000 next year and you should mortgage your house to buy Krugerrands. What I am saying is the setup for a reverse crash in metals is better now than it's been in years. And most people are going to miss it because they're conditioned to think in terms of crashes going down, not up. The other thing people miss is silver's volatility. Gold gets the headlines, but silver is the leverage play. It's more industrial, more volatile, and when it moves hard. If you believe gold's going higher, silver's probably going to outperform on a percentage basis, but it'll also hurt more on the downside. You've got to have the stomach for it. Here's the part that makes me laugh, though. People will obsess over whether to buy at $28 or wait for $26. They'll agonize over entry points, trying to time it perfectly while completely missing the bigger picture. If silver goes to $60 in the next cycle and you're arguing over whether you bought at $26 or $28, you're not thinking clearly. That's a $2 difference on a $30+ move. It's noise. The real question is, are you positioned at all? Because most people aren't. They're sitting in cash, earning 5% in a money market, feeling smart because it's better than the 0% they were getting 3 years ago, not realizing that inflation, the real kind, not the CPI nonsense, is eating them alive. You know what else nobody talks about? The mechanics of a short squeeze in metals. And yeah, metals can get squeezed. There's a massive paper market in gold and silver, futures contracts, ETFs, all kinds of derivative products that don't involve actual physical metal. If you've got 100 ounces of paper claims on every 1 ounce of physical metal and suddenly everyone wants delivery, what happens? Prices go vertical. That's not theory, that's math. We saw a taste of this in 2020 and 2021 when premiums on physical silver coins went absolutely insane. You'd see spot price at $25, but you couldn't buy an eagle for less than $35. $10 premiums. That's a 40% markup. Why? Because there wasn't enough supply to meet demand. The paper price said one thing, but the physical market said another. If we get a real rush into metals, if the reverse crash kicks off, you're going to see that divergence again, but bigger. And if you're not already holding, good luck getting it at a reasonable price. Here's what I think happens in 2026. I think we're going to see one more leg down in sentiment, one more period where people give up on metals entirely, where the narrative is inflation's beaten, metals are dead, move on, and that's going to be the final flush, the last chance to get positioned before the move starts. And when it starts, it's going to feel wrong. It always does. The best trades, the ones that really pay, feel uncomfortable. They feel like you're doing something stupid. Everyone around you thinks you're crazy. That's how you know you're early. The people who make life-changing money in markets aren't the ones following the crowd. They're the ones who see the setup, understand the mechanics, and have the conviction to act before it's obvious. By the time it's obvious, by the time CNBC is running segments on the gold boom and your neighbor's asking how to buy silver, the easy money's been made. So here's the takeaway. Gold and silver are setting up for something big, not because of conspiracy theories, not because the sky is falling, but because the fundamentals, the technicals, the sentiment, and the positioning are all aligned in a way we haven't seen in years. Central banks know it, smart money knows it, retail investors, they're still asleep. You don't have to bet the farm, you don't have to go all in, but ignoring this setup entirely, sitting on the sidelines waiting for confirmation that'll never feel comfortable, that's the real risk. The reverse crash doesn't announce itself, it just happens. And when it does, the only question that'll matter is whether you were ready or not.